I must be on a bit of a turnaround binge because after looking at BlackBerry stock, I decided to check out Carnival Corporation, which is the cruise company that has really been struggling since the pandemic forced everything to shut down. Now, really quick before we move on, I just want to point out one thing that's a little bit different about this stock, and that is that it trades under two different symbols in American markets. CCL is the American listed stock ticker, while CUK is the ADR for the British side, the PLC side of Carnival Corporation. Now, I'm not super well versed in the structure of this company and why they have two separately listed stocks, but I wanted to point that out just in case you were a little bit confused when you saw two different ticker symbols showing up on screen. So as I'm sure many of you are aware, Carnival is a cruise company, so their profits are derived from these large boats that people travel on and they go from port to port. So this is very much a travel and sightseeing type of company. They do own multiple brands, obviously their namesake Carnival, but they also own Ada Cruises, which is the largest German-speaking cruise on the market. There's Costa Cruises, which operates through Italy. Cunard and P&O Cruises are both British travel lines, and then there's Holland America, which focuses on more upscale, worldwide type tours. And then to top it off, they have P&O Australia, so operating in the Australian and New Zealand markets. And then there's the Princess and Seabourn lines, which are slightly more specialized segments of the company that offer either higher end or slightly, different, unique experiences for cruise goers. And so the name of the game for Carnival right now is trying to get back to their 2019 profitability. The company has been unable to do that, but there are signs of a turnaround in process. As we can see here, their net yields, revenue, and customer deposits are all higher than 2019. But of course, that's mostly top line numbers, and their bottom line has yet to reflect that turnaround. The company is on good track, though, with their net per diems as a percent of 2019 hitting 110%, and their 2023 occupancy is almost back at 2019 levels. So again, we're starting to see signs of a turnaround, but the company definitely has not surpassed its 2019 performance metrics. What is a positive to see, though, is that the company's revenue is still growing in multiple different ways. Their pre-cruise revenue has grown by 64%. The onboard revenue that's sold pre-cruise is up 10 points as a percentage of their total revenues, which is good. That tends to be a little more stable and they can better predict that revenue, right? And then the onboard revenue has gone up by 18% since 2019. And moving on over to the earnings that the company announced today, we can see that Carnival posted a smaller loss than expected and beat their revenue estimates on steady cruising demand. So all in all, this quarter was a very good sign for the continued turnaround of this company. The stock jumped 7% after Carnival announced its earnings, which is a really good sign to shows that Wall Street is also starting to catch on to what is happening and they're starting to approve of the company. And what was really encouraging is that the CEO said that they now have nearly 2/3 of their occupancy already on the books for 2024 in total at considerably higher prices. So that means that Carnival has secured a ton of its future revenue already, and that revenue is expected to be higher than it previously was. In fact, the company expects their net yields in the first quarter, which is the revenue per passenger per cruise day, excluding the costs of those revenues, to be up 16.5% year on year. So a very large jump on the top line revenues. The country's forecast for fiscal year 2024 net income of $1.2 billion was basically in line with Wall Street's expectations, which for a company that's trying to turn around is usually considered pretty good. And of course, here at the bottom, we can see their actual numbers. They posted a fourth quarter net loss of $48 million, which equated to 4 cents per share, which compared to a loss of negative $1.27 per share a year earlier. So a major improvement over the year prior. And they also beat analyst expectations of negative 13 cents for the quarter. So all in all, a pretty solid report. The company is not yet profitable, but their top line recovery is really starting to outpace expectations. And their bottom line, although still in the red, is really starting to perform well also. Really quickly, before we move into the financial numbers, can you please take a moment to like this video and subscribe to my channel, as it really helps me figure out what kind of videos you guys like to see, so I can know what content is best to bring to you. Thank you so much in advance, and let's get into those numbers. Like we saw earlier, revenues have been rebounding nicely since 2020 and 2021, and the trailing 12 months are just under their 2019 highs, so I do expect those 2019 numbers to be eclipsed fairly soon. EBITDA has more work to do, but at least it is positive in the trailing 12 months. Operating earnings, on the other hand, have yet to show profitability, but in the trailing 12 months, it's at essentially zero compared to the major dip of negative $7.50 per share that it experienced in 2020. Gross margins are also recovering nicely, sitting at about 47% versus 53% pre-pandemic. So still some improvement needed, but the trend is in the right direction. Operating margins just went positive and they're sitting at 4.3%, so well under the 16 to 18% operating margin that the company had pre-pandemic, but it definitely beats their low of negative 330%. And of course, the return on asset numbers are continuing to solidify our thesis that Carnival is starting to turn their operations around, but they still have some improvement to do. Shares outstanding have grown massively at over 16% per year, so this is our first bit of really bad news. As a shareholder, you never want to see this type of growth in the amount of shares outstanding, but I do have to say it is understandable because the company needed money and they needed it really bad because through no fault of their own, they were not allowed to operate and they were not allowed to sell their product to customers. So they needed to make money somehow and they decided to make that money by selling shares to the open market. The company's cash and short-term investments have been dwindling since 2020, but this is again another part of the process of normalization as their current balance of about $2.8 billion sits a lot higher than their pre-pandemic numbers. So it is good to see that this company has a very strong cash buffer as they will need that due to their debt load, which we are going to get into right now. And yeah, there it is. It does not look very good. The company's long-term debt has exploded since 2019 for understandable reasons, but it currently sits around $30 billion, which is a ton of debt for this company. Carnival's most recent net interest expense was negative $1.8 billion. So over the trailing 12 months, the company has paid out $1.8 billion just to keep up with its interest payments. To put that into perspective, we just saw that the company's cash on hand was about $2.8 billion. So in just under 2 years, if this company raised no money, they would not be able to afford their interest payments. That's the level of indebtedness we are talking about right now. Levered free cash flow has been negative since 2018 actually, so the company was experiencing some issues going into 2019 before the pandemic, but at the very least it has shown improvement along with the rest of Carnival's financial metrics. This is further supported by their free cash flow per share numbers, which is sitting at negative 43 cents per share. A major improvement over the negative $12.80 per share in 2020, but still well under where they'd like to be, probably back at that $250-ish per share number that they had in 2018. And leading into the pandemic, Carnival did pay a steady and rising dividend, but of course, given the company's situation, management chose to cut that dividend, and I completely agree with that decision because there were literally zero revenues coming in for the company, and so they needed to conserve every dollar of cash that they could. I personally do not expect this company to begin paying a dividend in the near term as they do have some major debt problems that I think they would like to resolve before they start paying out cash to shareholders. And once again, I've skipped the PE chart because it really doesn't give us any valuable information. But here looking at the value chart, we can see just how far Carnival has fallen. The company's stock peaked at around $70 or $75 per share and then fell precipitously down to about $8 or $9 per share and has basically hung around that level ever since. Now, it's certainly been a volatile ride because just about 6 months ago it was sitting at $7 per share and now currently sits at around $18 or $19 per share. But a lot of this volatility is based on the speculation that the company will turn around and not really due to the company's performance itself. Since the company has negative earnings, we can see that the value line is just sitting at $0, so that's not entirely helpful. But if the company was able to return to its pre-pandemic valuation, we could see a fair value for this company sitting around $60, $65 per share. Now, I do believe it's going to take a long time for Carnival to reach levels like that because of the debt load that they now have. And I did want to point out that the projected compound annual growth rate from Yahoo Finance and the analysts that they cover is currently sitting at negative 151% per year for the next 5 years. Now, I'm not entirely sure if that is a calculation error on the part of Yahoo because I don't know how something can fall by more than 100%. And it's possible that the negative numbers have affected this calculation in some way. But the point remains that most analysts expect Carnival to really struggle, and this is basically due to the debt burden that they now carry. There's going to be no easy, quick fix for Carnival. They're going to have to pay off that $30 billion in debt, and they're going to have to do it quickly because those interest payments are taking literally billions of dollars a year from the company. And so, to cover what I like about this company, first and foremost, Carnival is a very recognizable brand name. When I think cruises, Carnival is one of the first companies that I think of. And so I think that is a positive for this company. And second, it does look like the company is managing to turn things around. This turnaround is going to be slow, it's going to be painful, and it's not going to happen in 1 year or 2 years or even 5 or maybe 10 years. I mean, this is going to take a while for them to pay down their debt load and get to a point where they can actually have free cash flow that they can pay out to shareholders or use to expand their operations further. The signs are there. Now we just need them to continue to turn things around and continue to show that their bottom line especially is starting to improve. And for the cons, I think I've made it very apparent that their debt load is extremely high, and it is going to be a major burden on this company for many years to come. Secondly, the company is still struggling to return to profitability. Like I said in the pros, they are turning things around on the top line, but their bottom line is still struggling. It's taking a little bit longer. And while I do see continued improvement from the company, I also see their competitors improving at a faster pace. So when I think of other companies like Norwegian Cruise Lines, they seem to have returned to profitability quite quickly following the pandemic, and that has not been the case for Carnival. So while I like the direction the company is headed, I do worry that management is struggling to execute to the same level and to the same degree as their competitors are. And finally, the cruise industry is highly exposed to consumer demand shifts. Obviously, being in the travel industry means that your revenues are going to fluctuate a lot with the free earnings and the free money that consumers around the world have. So if we were to experience a recession of any type, I would expect cruise companies in general to really struggle. So of course, with that being said, I do not view Carnival as a great investment right now. I really like the company's continued turnaround and the progress that they are making on their debt payments, but I think there are just too many risks that lay outside of Carnival's control for me to be able to invest in this company. Now, of course, you are your own person, you are your own investor, and this is not financial advice. So if you see value in Carnival, by all means, invest your money how you please. And if you do choose to invest in Carnival, I wish the best of luck to you and your investment. And so with that, guys, I hope you enjoyed the video. Please like the video and leave a comment down below, leaving your thoughts on Carnival or any other stock in the stock market. I would love to look at them and have a conversation with you. And with that, I hope you guys have a great day. Bye.